Hello everybody, my name is Dimitri, website cryptoparadise.consulting. I'm happy to be with you for the beginning of those 5 sessions, let's say training sessions on YouTube, which are going to be 5 videos called Unbank Yourself. I'm doing those now because I think it's the right moment. We are living, as you probably all know, in a very strange world, especially regarding the financial and monetary aspect. So before we start with this, I'm gonna introduce myself. First of all, you're gonna listen to this and you're gonna hear it while I'm speaking. I am a French mother tongue. I've born and raised in France, and I've lived there most of my life. I moved to Mauritius, where I am now, in 2018, about 2 years ago. Very happy to be here. Beautiful country and very nice life here. Nothing to say about that. So first of all, excuse my French, would I say? So mostly I would say excuse sometimes my English, where it's not my mother tongue. It might be a little more difficult sometimes to find the right words. But anyway, I've been speaking and using English since many years, so I guess it's going to be quite easy still. My history is that I was an entrepreneur all my life. I think I had in my whole career about 8 months in my life I was an employee. And except of that time, I always been an entrepreneur, building companies, small ones, small size, but anyway, knowing exactly what it's all about, to risk your money, your time, to build something, starting out of nothing. Anyway, it was in 2006, 2007 when I started to really get into how our world functions, especially in terms of financials and how the monetary system functions, how states, governments functions in terms of how do they get their money from. All this, I started to open my eyes on all those subjects around 2007. Actually, I will remember seeing at that time a very interesting video which was named Money as Debt. I think I saw that for the first time probably 2007. I'm going to try to find the link and put it down this video for you to be able to look at it. It's a bit old now, but it was a great little video, kind of cartoon way, where it explained all the history of money. Very interesting. So in 2008, when the financial crisis occurred, it really opened even more my eyes on all those subjects, and I realized very clearly that we were living in a world where there was a lot of delusion, and actually what I thought until then was I thought I was really living in an objective, capitalistic environment where everything was based on unbiased bid and offer, sound markets, and that was the idea of the world, the idea I had of the world we live in. 2008. With all this new concept of too big to fail, central banks coming in and saving whoever they wanted to save. If you were a big corporation, a big bank, you got the possibility to be saved easily. Whatever you did before, whatever bad bets you took, you were too big to fail, you were saved. And if you are a small, medium-sized company, like I am, for example, but like many of you are probably, or working, well, in that case, you're just garbage. You're allowed to go to trash, and nobody gives a shit about you. So this rigged system, got my total attention. So it's been now 12 years, because now we're in 2020. It's been 12 years. I'm just reading, studying, learning about all those subjects. So what I want to do here, I already did it actually in French. You're going to find it on my website, cryptoparadise.consulting. For those who speak French, well, I would suggest you go and see it in French. Will be probably easier. I'm now translating this in English. And why do I do it? It's because what I want is to bring the maximum people to really understand, especially people who are probably newcomers, who maybe don't know a lot about all those aspects. I want to bring people to understand that it's time to unbank yourself, and the solution to unbank yourself are now completely existing. And not only they exist, they thrive, and they allow you to be very profitable for you. So especially looking at DeFi, decentralized finance, which I became very familiar with in the especially the last 2 years, since I'm in Mauritius actually, and those subjects are not only fascinating. I'm completely into them. I really like those subjects, and I think they're also the future for the finance system for humanity, and for the first time. With the creation and the invention of Bitcoin, a new system was given to humanity which allows a totally decentralized way of using money, absolutely uncorruptible, absolutely safe, censorship resistant, etc., etc. So a very new system which we can call money over IP, MOIP. I'm doing this to bring the maximum people, and especially people who don't have this financial background. I'm going to use everyday word to make it very understandable. And there is also another reason, is that I'm now an ambassador of an app which is called Celsius. And Celsius is probably the accomplishment of what DeFi today, let's say today, does at best. Celsius allows you to get much higher returns on your liquid assets, and has now come out not only on liquid assets like dollars, like any stable coins, but also on crypto assets like Bitcoin, Ethereum, and even others. And now, since 1 week actually, also with gold. So it now has a full range of the best liquid assets that exist, and that allow you, especially with gold, for the first time in human history, you can get interest rate on gold. You can earn gold on gold, which is quite unbelievable. It's the first time this happens. Until now, we had very different ways of keeping your gold. Either you had it physically, or you had it stored somewhere where you had to pay for it. Well, now it's the opposite. We're going to talk about that in those sessions. But to be able to access all those subjects, I thought I had to do it in a very chronological way, and to start with the beginning. And the beginning is how it all started in 2008 with the financial crisis, and to explain how the monetary system works. That's going to be session number 1 that we're going to do today. Session number 2 will be the invention of Bitcoin by Satoshi Nakamoto. Session number 3 will be exchange platforms and the first real-life applications for Bitcoin and for cryptocurrencies. Session number 4 will be DeFi, how decentralized finance becomes reality. And session number 5 will be the solution Celsius explained to you. So one important thing, I'm gonna go sometimes I'm gonna, as you can understand, I'm gonna try first of all to, to summarize those 12 years of study of reading in 5 sessions, which last between 30 minutes and 1 hour. So it's not an easy job, let's say, but sometimes I'm gonna be probably quick on some subjects, maybe not deep enough for some of you. And one thing you should do is, of course, that's the beauty with video. You can just put it on pause, and especially you can go and do your research by yourself. It's a very good way to do it. Don't forget that everything I'm giving you today, I found it. It's there on internet somewhere, and I found it just by going on internet. So all the subjects are very easily found on internet, where you will be able to go deeper in many of them. Don't hesitate to do that. Another way for you to go deeper is also to use to ask questions on my blog, cryptoparadise.consulting. You can easily ask questions under every video, every post I have on this blog. You're able to put your comments. So don't hesitate to ask questions there. I'm gonna be very happy to answer them. And you can also write me in a private manner if you prefer that. Also on that same website where you find my contact details. I'll be also very happy to answer any type of question. So that's it for probably for the introduction. We'll now be able to start. And here we go with session number 1, which is the financial system and the 2008 crisis. So first topic we're going to talk about is the first thing very important to understand is how do the countries or the states get money from. So today there are 2 ways for any country, any government, any state to get funded, so to get access to sources of income. It's either tax or borrowing, loans. So the first question we have to ask ourselves is, what is a state? What is a government? Especially in Europe, in France for sure, the word state is very, very much used, and in the French mentality, which is a little different from the Anglo-Saxon mentality for sure. In the French mentality, and probably more in Europe than in the US, the state is seen as an existing entity. So the first question I want to answer is what is the state? And I will answer in a very easy manner, which is there is no state. The state doesn't exist. There are only taxpayers. So this has to be very clear in everybody's mind. There is no state. As soon as you get tax money away, the state just vanishes, doesn't exist. So that's very important to understand. But the problem is that many states, and especially today, I would say all states, almost all of them, maybe not all of them, but almost, in the world, do not manage to collect enough taxes to pay their expenses. So in that case, what they have to do is borrow money, which is understandable. It's like you, actually, like any entity, can be a company, can be an individual. If you spend more money than what you earn, you will have to get it somewhere, which will be a kind of debt. So that's how states get money, by collecting tax or by borrowing it. And we are all taxpayers, however you look at it. So even in countries where a part of population doesn't pay direct income tax, which is the case, for example, in France, about 50% of the population doesn't pay income tax because they have too low income. But even those people are taxpayers, because don't forget, we pay tax not only in terms of direct income tax, we pay indirect tax like VAT. And all countries today have VAT. So as soon as you buy any product in any shop, you pay tax. So we're all, that has to be very clear, we're all taxpayers. So one thing which is very important now, the second topic, is that countries, to borrow money, will go on markets and they will issue treasury bonds that will be sold to investors on bond markets. So this is something I will not go too deep into it, but I will have to explain it a little bit. One thing which is quite remarkable is that all money which is deposited in banks by individuals or any corporation, so any bank holder, this money might be, without you knowing it, lended to countries or to states via investment banks are doing. So banks are a big part of the institution that will buy those government bonds, but not only them. Big corporation and even you as an individual, you're able to lend money directly to your government by buying those treasury bonds. What is a treasury bond? Let's make it very simple. A state, a country will issue. Let's take a very simple example. Imagine a country which issues a bond which value will be, let's say, 100, whatever, dollar, euros, whatever you want. Let's say $100. So if you buy this bond, you're gonna pay $100 that will be directly lended to the state that issued it. Now, with this bond is attached a coupon, which gives you, if let's say the state gives you 5% interest rate, so every year, and the bond has a maturity also, it has a coupon and a maturity. So let's say the maturity is 10 years, so you pay 100, and in 10 years, you're going to get your 100 back. And during those 10 years, the coupon will be, let's say, if it's 5%, it's going to be $5 every year given to the bondholder. Now, as soon as this bond is issued, it starts to go on the market. It's on the bond market. So it can move. There can be bid and offers on this bond. So I bought it 100 as an investor. Tomorrow I can sell it 110 or 120 or maybe 90 or 80. I'm gonna be able to lose or win on my bond value, and someone can invest in that bond and become the new bondholder, and will still get for 10 years these $5 coupon. So you understand that if, for example, the bond value 1 year later becomes 200, well, the person who buys the same bond that was issued a year before for 200 has immediately a side effect, which is that because he still gets $5 every year on the bond as a coupon, well, the interest rate was just divided by 2. 5 on 200 as interest rate is, of course, the half of 5 on 100. 5% becomes 2.5%. Now, this explains you this very important relationship between the bond price and the interest rate. Very important to keep in mind. Those interest rates are completely linked to the bond value. And the higher a bond value is, the lower is the interest rate attached to that bond. And the lower the bond value is, let's take the same example I was taking earlier, still for that bond that I bought 100, if in 1 year the bond value is only 50, then that means that the interest rates now, because this bond still gives a coupon of 5 every year, the interest rate is now 5 on 50, which is now 10%. So the interest rates just doubled because the price of the bond was divided by 2. I guess this is now very clear for everybody. Okay, before we move into why did everything change in 2008, which is, of course, the very interesting point. Before we do that, we need to understand that, as I was explaining a little earlier, the money that goes into those bonds were coming from institutions, and a lot of time came directly from banks. And banks, have the money that are there because of their depositors. So you, as a depositor in your bank, you just don't know where your money goes. The bank owes you that money. It's not really your money. It's money that the bank owes you once you have it in your bank account. That's a very also important aspect that most of the people don't realize. It's not their money they have on a bank account. It's money that the bank owes them. If something goes wrong with the bank, and we saw that in 2008 and further, especially in Cyprus, for example, in 2011, you see that your money is in danger. It can be very easily in danger. And the other thing is that it's invested in things you don't even know. You don't even know what they do with it. So they lend money to the state, and this shows you a very, very important thing you have to keep in mind also, is the fact that your savings are the debts of government. They're completely linked. So you have a situation where if you wanted to erase debt, it really means you're gonna kill the savings. It is so when you hear people, and this is something you hear a lot in the blogosphere, lots of commentators, whoever, they say we just have to erase the debt. You cannot erase the debt without just killing the savings of millions of people. So it's not easy to save the debt. It's not something you just say, okay, let's just erase debt. No, if you erase debt, you punish all the savers, which is absolutely unjustifiable. So it's not something that you can do like that. So savings and debt are completely linked, and one goes with the other. The debt we have in the world is the equivalent of the savings that investors were willing to give to the borrowers. So you cannot erase debt without killing the savings. I repeat that again because it's very, very important. So let's now go to the subject, another topic, which is what happened since 1945, since the end of World War II. Well, we have two very important dates that you need to keep in mind, which are 1944 and 1971. So, first date, 1944, it's the date of the Bretton Woods Agreement. That's when the World War II ended, and the USA came out of that as being the leading country of the world, by far. They decided, because they saved everybody, makes sense, they gathered all their allies in New Hampshire, in Bretton Woods, and that's where they signed the agreement, the Bretton Woods Agreement, which decided how the monetary system would work for years to come, after 1944. And basically, again, without going too deep into it, but I'm going to put many links down my video. You will be able to go and look it for yourself. the situation was simple. All currencies were had a fixed peg to the dollar. The dollar was the world reserve currency, which was used for every trade in the world. And the dollar was backed by gold at a fixed rate, which was $35 for 1 ounce of gold. So gold, which had always been in the human history, the money, had always been money with intrinsic value, which is gold. Humanity has always believed in gold as being money. Well, in 1944, the situation was a bit in between, where paper money was used, but at the end of the story, it was backed by gold at the rate of $35 for $35, for 1 ounce of gold. But gold was not redeemable by any individual. It was only redeemable by countries who had excess reserves in dollars. They were able to ask the US to give them the equivalent of gold at this rate of $35 for an ounce of gold. Well, during the years that followed 1944, at least for 20 years, nothing really happened. The world got those glorious years. In France, we call them les 30 glorieuses, which means the 30 glorious years, where we had growth, crazy growth in almost all countries in the world, and especially Western countries, but even Eastern European countries had their part of growth also. And we had exceptional years. So at that time, I would say, the question about how the monetary system was working were not really on the table, even though things were happening clearly. But it all started in the 60s when, things started to happen on the gold market, and with this fixed rate. It was not long before the voices started to raise and ask a little and question a little bit this system. Well, one person did it, and a very prominent person. It was the president of France, General de Gaulle, who in the 60s, there is one very famous speech in front of the press in 1965, where he clearly questioned the whole system and started to understand. Well, he understood it probably. He didn't start to understand it at that time, but he made it very obvious to everybody that this dollar reserve currency system was allowing the US to print a lot of money, and this was not very it was not very balanced. And he actually made it clear that it was even, a kind of fraudulent way of doing things, when you have one country that can print, and create budget deficits, if every other country in the world has to use the dollars. And don't forget that at that time, any commercial trade between countries in the world was done in dollars. If Germany was selling something to France, they were doing it in dollars. So quite an amazing system. So it was quite amazing, because de Gaulle, in that speech, I'm going to try to put you the link where you get the English subtitles. It's very interesting to see how he put it, and he concludes that we have to go back to a real gold reserve system. But what he did, he started at that time to simply send back the dollars the France had in reserve to ask for their redeemable gold. So, there is this famous moment where you had Navy ships, French Navy ships close to the US coasts, getting the gold back to ship it back to France. Quite amazing, huh? So you can imagine how, at that time, panic started to rise in the U.S. Leaders' heads, and because they were, of course, realizing that if now everybody would start to send back their paper dollars to redeem their gold, well, there could be a very, very dangerous situation for the U.S. because maybe the gold was right, and maybe they were printing much more dollars than they had gold, than they had than was backed by gold. So we again go in this process of it's not a bank run. It would have been a gold run on the gold possession of the U.S. Actually, questions today are lots of questions are raised about the reality of the gold of the U.S. gold reserves. We had I'm going to talk about that a little later, but we had after 2008, lots of questions were raised by an entity called GATA, the Gold Antitrust Committee. They did a fantastic job, explaining how gold market was rigged. But that's another story. We're going to go later into this. So, it was not long until other countries started to imitate also the gold. You get other countries who said, "Oh my God, look at what." France, a major country, look at what they're doing. They're asking for their gold. Maybe we should do the same. So, as you can imagine, the situation could have gone very quickly out of control. And to avoid a very dangerous situation for the U.S., Richard Nixon, who was the president of the U.S., that's the second date I was talking to you about, in 1971, on a Sunday, he decided to go on TV and explain that starting at that moment, the US dollars would not be redeemable in gold anymore for normally a provisory measure, so for a period of time which would end, but of course it never ended. As usual, as we could have guessed. But at that time, he promised it would be provisory, and he decided this completely unilaterally, without involving any of the other allies. He decided this himself, just putting the U.S. out of an agreement it had with other country because they signed a treaty. So they just got out of a treaty by themselves. Well, it's not something very unusual because we've seen this again and again in the US history, and especially very lately we saw it how when a new president got elected, he just get out of another treaty, which was the treaty with Iran about the nuclear facilities in Iran, which was signed by Obama, and just Donald Trump decided. So after 1971, and after that decision was taken, as you can imagine, there was a kind of very tense moment in the world where everybody was thinking, where is it going to go now? The abandonment of the gold standard might have terrible consequences. First of all currencies started to fluctuate once again, one against each other. Gold was starting also to fluctuate. So just to give you an idea, between 1971, before this Nixon decision, gold was $35 an ounce. It went up to $800 an ounce in 1980, and today we're now around $1,700 for an ounce of gold. So it shows you already that in the last 50 years, it multiplied by 50, from $35 to $1,700, and it's probably going to go much higher. So that was one consequence, and on times of big uncertainty started around those years. We had big inflation rates. All countries had the two figures inflation. We were, I remember me being young at that time, very young. I was a child actually, but I remember even I talk about it to my parents. They were very familiar with the 14, 15, 16% inflation rate, and it was strange time. All this ended in the 80s when the Federal Reserve policy completely changed, and sound monetary interest rate were brought in. And one thing which was done at that time in the 70s, and this was a very smart move by the US actually, was to actually be able to replace the gold standard by a new standard, which was the petrodollar standard somehow. Okay, we can call it petrodollar standard. But this enabled the U.S. to not lose its dollar reserve currency predominance, and they did this by simply sending, at that time, I think it was Henry Kissinger who was sent to Saudi Arabia, and they made a deal with the Saudis, asking them to promise to only sell their petrol against dollars in exchange of a total military protection of the Saudi kingdom. And well, the Saudis signed this, and that's how we got on. And this led to to different crises. We remember the 1973 petrol crisis. But anyway, it allowed to the dollar to remain world reserve currency, as everybody now needed dollars to be able to buy oil. And oil is something which is called the black gold. Oil is something anybody needs, any country needs, so every country still needed dollars. So that's how they got away with it. Anyway, so at that time it was another way of doing this. So that's 1971, very important moment in monetary history, because since 1971 we are all in a world where currencies, and especially the world reserve currency, which is the US dollar, are not backed anymore but by anything. They're just fiat currencies. We call it fiat currency, meaning that it has no intrinsic value anymore, nothing, zero. It's just now debt, which is issued at will, but by the Federal Reserve, and the budget deficit of the U.S. can grow and grow. Soon as the system continues to use the US dollar as a world reserve currency, there will be a need for dollars in all the world, and that ensures the US of a fantastic dominant position. So that's the world we live in. So let's now move to another topic, very important, which is what is a loan actually. A loan is always, there is always in a loan two things that are implicated. You get on one side the loan itself, which is a lender which gives to a borrower a certain amount, and there is a collateral, which is what the borrower gives to the lender as a kind of guarantee for the lender to be able to get his repayment back. Now, in terms of collateral, it's very important to understand we have different types of collateral. Some are very high value, high quality collaterals, and we have very low quality collaterals. So let's take a simple example. If you go to the bank and ask for a loan to buy your house or your apartment or real estate property, it's simple. The bank will ask you normally to put a down payment, maybe 20-30% down payment, and they will also get as a collateral the asset you're buying, so the apartment, the house. And if for some reason you're unable to repay at some point in time, they will be able to seize this apartment, this house, this real estate property, and sell it to get their money back. So they have, let's say, a high quality collateral, being the asset you're buying. Especially if they get a down payment, actually they lend you only 80 or 70 or 80% of the value, and they get collateral which has a value of 100% of what you borrowed. So It's a high quality collateral. Now we can take another example, which will be an example of low quality collateral, which is a simple signature. So if you are, let's say, unemployed, for example, and you go for a loan of $5,000 or $10,000 to buy a car, or to buy anything, actually, any consumable product, and the bank simply gives you the money and takes as a collateral your signature on a paper, which becomes the collateral. This is low quality collateral, because if they only have this paper, which is a signed contract by you, well, this promise can be very easily not fulfilled. If for some reason you don't have any money anymore, I mean, if you're unemployed, obviously you don't have a job, you don't have income. Well, you're unable to repay, and the bank has nothing except this piece of paper. So this is to give you an idea of those different collaterals we can have on the market. Well, when a state borrows money, it uses, the only collateral it gives is this signature. So what is amazing is that in the world today, the highest quality in terms of collateral in the whole financial markets is the US Treasury bond. So the US signature is considered in all the investment world as the most serious signature that exists, and the safest asset where you put your money in is into a US Treasury bill. So this is a question you have to ask yourself. Does it make sense? But that's not a question I'm going to answer. I'm going to let you answer to this question. But that's how it is. You get other very important signatures in the world today. You get Germany, who also has a very serious signature. Switzerland, other countries. But basically the US. So maybe the US is now on the verge of losing it. But until yet, it's still there. And actually, we even see it today, where the US dollar is now at a very high level, and the US index, it's at its highest level. So there is still lot of demand for US dollar. So it still holds. The system still holds this way. Okay, so now once I explained all these, we gotta now go into what happened really in 2008. What is that really changed? Well, what happened in 2008 is that at some point before 2008, lots of loans in banks were very bad quality loans, and banks were knowing that they had lent much too much money, especially in the US, for borrowers who had very low quality collaterals, and sometimes very bad signatures. So they decided to repackage those products with the help of specialists, Wall Street specialists. However, I'm not going to go deeper into that, but to make it simple, all those bad loans, those bad signatures, which were papers, as I was explaining earlier, they were just repackaged and resold on the market with AAA, which is the best note for investments, AAA rates to new investors. So the banks got rid of their bad loans, by this way, and again rigging the game. It's kind of enormous fraud, but nobody got really sued about that. Okay, so in 2008, all those bad loans, start, to burst. This bubble started to burst, and this was the panic of 2008 when we saw the fail and how Lehman Brothers, big bank, just completely failed, and that's when we came up with this new wording about this crisis, which was not anymore a regular crisis, it was a systemic crisis. So what does it mean, systemic crisis? It means that the system is in danger. So whatever that means, you understand that behind those words, it was a way to make everybody understand that measures had to be very, very unconventional measures to save the system. Whatever the system is, system is in danger doesn't mean nothing if you think about it. Some companies, yes, some big banks, some big corporations were probably in danger of simply disappearing, of bankruptcy. And what's the problem? That's capitalism. That's logic. That's market logic. You just have a wrong business model. You made wrong bets. You disappear. Nothing wrong about that. There is no danger for the system. But however, the systemic thing came up, and it was clearly decided that states, governments had to come in and save the system. So how would they do that? By borrowing, of course, because they inject money to give money with budget. So creating more and more budget deficit to whoever they decided to big banks, to buy their stupid assets that they already all those packaged worthless piece of papers they would now be bought at their highest price by budget deficit, which is your money, which is taxpayers' money. But of course, because they don't have the guts to ask for more tax immediately, because people would be maybe angry, they of course go on the market to borrow. Now, if they go on the market to borrow at that moment, we all understand that maybe investors are not going to buy, to their treasury bills, especially if the interest rate they proposing is a low interest rate. And you can easily understand that for a state that goes now into crazy debt figures, having a high interest rate is just impossible. Then, of course, you put your budget in a situation where clearly, the year to come are going to be just impossible. If you have more than 5, 6, 7% interest rate, forget it. And usually on a regular market, the more you get a person in difficulty of repaying, of course, the highest interest rate it has to give to be able to borrow money. What investor, normal investor, sensible investor will be ready to lend to an entity, to a government, to a person, to an individual, to a company that is already close to bankruptcy? Nobody does that, except, there is a very high risk. High risk has to be paid for. So, except if you give a very high interest rate, and we saw what happened during the European crisis in 2010, 2011, when Greece, if there was no intervention, Greece would have there was some Greek bonds had like more than 20% interest. In this configuration, this is exactly how we were when in 2008 the countries, and especially the US Treasury, decided to come in to save what they called the too big to fail. So some corporations, some big banks, were the ones chosen by the ones who know, the elite. They know who they have to save, and they were saved with this taxpayers' money. So, of course, as I was saying, because they were not able to raise tax immediately, they went on the market. What happens at that moment? Investors, regular investors, cannot come. They're not going to be able to sell their bonds at those levels to normal investors. So that's when they had to ask the central bank, the Federal Reserve, to come in and be the ones who are going to buy the treasury bills. They're the ones who are going to lend money to the US government. And that's when it becomes really tricky. Because first of all, it's not really allowed. It's not supposed to be in the laws of an independent central bank. The central bank is not supposed to create money to bail out any government. But they found ways to do it. So let's now not go deeper into that, but they found ways to do it easily, you know, with intermediaries. And they call it, you know, they found now, again, new words, you know, quantitative easing. What's that? You know, when it appeared, you know, everybody was saying, oh, what is quantitative easing? And I remember at that time, you know, we had a fantastic chairman of the Fed, you know, after Alan Greenspan, we had Ben Bernanke. This guy was amazing. He was explaining to everybody that he was not printing money, because printing money means you print money out of thin air and you just throw it to budgets. No, it's not the case. They were buying assets. They were buying assets. What assets? Well, treasury bills. And those treasury bills, don't forget, are the safest number one asset in the world. So they were accumulating treasury bill at a rate that was never seen before. And the balance sheet of the Federal Reserve was just growing, again, at a rate that was never seen before. But that's how it went. And this is the moment where I really understood that we were in an absolutely rigged game, because now here is the situation. On the markets, and the most important markets of all markets, forget stock markets, forget real estate market, the most important one is the bond market, because it decides of interest rates. And interest rates is the most important indicator for any asset price in the world, because that's where all asset price come from. With high interest rate, your investments are completely different than with a low interest rate environment. And the asset price are completely depending on those interest rates figures. It is a very important indicator. What happened at that time? Well, simple. As soon as you have a player on a market where any player is a regular person or an institution, investor, whoever, you now have a new player, which is a central bank with unlimited supply of money, because they just can invent it. You have to understand that when they buy treasury bills, they buy it with money they just created. So it is money printing. It is money printing, but they just don't say it. So they print the money, they create money to buy those assets. So what do you have on the market? You have a rigged market. You have a market where one player has unlimited supply of money. You don't even know how much, you know, and it can come in more and more and buy and buy and buy. So of course the result is higher bond prices, and as I was explaining earlier, higher bond prices lowering interest rates more and more and more. And look at where we are today. We're close to zero interest rates, which is unreal, which is unprecedented, and makes no sense, not only on a monetary aspect, but on a philosophical aspect. Zero interest rate means that future is equivalent to present, which makes no sense. Okay? When you have an interest rate, positive, which is logical, it means that your future is a little bit uncertain, more uncertain than your present. And it is logical. It is logical that if I propose to you $1 now or $1 in a month, you're going to take $1 now. To accept to wait for 1 month, you're going to need a little more than $1. Don't need to go too deeper into that. I think it's self-understandable. So we're now in an environment since 2008 where central banks are just coming in and just rigging all markets. And this is the situation we are, where we see now. This is the question, you know, why are asset prices so high? Why is your house, that value was maybe 100,000 20 years ago, how is it possible that it's now 500,000? dollars or euros or whatever. Does it make sense? It's the same house. So the value of your house hasn't changed. It's the house. You still have a roof. You have the same number of rooms, except if you did some construction in it. Okay, then you added value. The difference is that it didn't gain value. It's the value of money, which just went down. So this is supposed to create inflation. And that's where there is another rigged game. There is fraud everywhere. Now, you should tell me, if we see those rise in asset price, where is inflation? Why isn't there inflation? Well, simply because the way inflation is calculated is rigged. They're going to decide that they put in the basket of the consumer price index some prices of goods that and they change it all the time. So as soon as one good will go too higher and higher, they will decide that this good is not bought anymore by the average consumer because the price is too high, and they just put it out of the basket and bring in some new items. So this consumer price index is completely rigged. And also, it doesn't take into account the asset prices. The value of your property or real estate is not in the consumer price index. So at the end of the story, you get a CPI which is very rigged and which doesn't show the real figures. We all understand that if your housing price and the housing price is a very important part of a family expense today. So to say this is not calculated in the CPI makes no sense. But that's how it is. So there is I'm going to put you the link. There is a website called ShadowStat which shows you the real. What they think is the real CPI. You'll see it's very, very different from the official one. So this is for this very important topic. We are now in this new era of rigged markets with rigged market participants, because one of them is simply a participant that has unlimited access of money. I wanted to give you a very simple example about that with a game that everybody knows, which is Monopoly. In the game Monopoly, as you know, we all start with an amount of money at the beginning of the game. So let's say we are four players on the table, A, B, C, D. Everybody receive 1,500 units, let's call it dollars, $1,500, boom. So we all know there is $6,000 on the table. We start to play, depending on your ability and your luck, there comes a point where there is no streets to buy anymore from the bank at the game, and everybody has some money left. Some have a little more, some have a little less, but we all see the money of everybody, and we all know we started with the same amount. Now, at that moment of the game, as you know, there is a moment where when there is no more street to buy from the bank, we decide to be able to sell the street peer-to-peer directly, player to player. If you're interested in my green street, because I have two, and if you have two and I have one, you might be interested in buying my one green street. So you have all the three of them, and you can build your house and hotels on it. So at that moment of the game, that's when the streets are going to be sold at an agreed price among players. Well, imagine that at that precise moment, imagine that let's say player A receives, without other players really noticing, receive, let's say, 30,000 from the bank. What do you think this will have as an effect? Well, immediately A, if let's say B has streets that C and D would like to buy, maybe they would buy, maybe the street price is 300. They might be offering 350, maybe 400, but not more. Now imagine A arrives and says, I'm going to buy it 500. He's going to get them all. B is going to sell every street that A is interested in to A, because A will pay more. Now, C and D are looking at that, and they see the asset price just raised. They don't have the money. B, who was close to A, got a little bit of the money because he sold his asset more than what he bought. He made already a nice capital gain on it. A was the one, of course, who was the most, who profited the maximum, because he got the money directly from the bank. B has a little profit of it. The asset price are now raised. Now, when C is going to come in, the first effect it will have is the fact that C is going to see that the asset price are now different. So even between C and D, they're going to exchange their assets. You can be sure not anymore at 350 or 400, because they see that the street was just sold 500. So the new price now, it's 500 for a street, etc. You understand the idea. The second effect of that is the Cantillon effect. There is actually a video I did. I'm going to put you the link on it. And the Cantillon effect is exactly this one, where you see how the first one who get access to the money is the one that takes the maximum profit out of it. By the time the money goes really into the market, and when it comes to B, to C, and to D, you understand that D, who is at the end of the pyramid, he is in front of asset prices that went up, and he didn't see a color of the money. He's the one who is completely rigged from the game. So the Cantillon effect is an effect that also is very, very important to understand, because it shows you how the money printing in the market actually has an effect, which is to enrich the rich, the ones who are close to, who have close friends at the central bank, the big players. They got the most out of the money, and they enrich themselves very quickly because they buy assets at the low price that was existing before with all this maximum money they just received. The guy who is at the end of the pyramid, it's exactly the opposite. He doesn't see the color of the money. He just sees a little bit of it at the end of the story, and the asset prices have already doubled or tripled. And this is the history of what we're seeing today, is that for young people, for them the game is completely rigged. They come into the market today, people who are between, 15 and 25, they are just in a world which is crazy, because they just they don't have income. They start, they're going to start earning income, which are going to be very low, actually, and they face asset prices which are completely madness. How can you buy a house or an apartment today? I just had, that's another story, that I have examples of people who now get into debt for 30 years. 30 years of debt to buy, a house, and put 40% of your monthly income into a mortgage. Anyway, you get the idea. So here we are in an environment where we have a rigged market, where we have crazy debt, so it's a debasement of the currencies. Every currency is doing exactly the same. You get the same now on the Federal Reserve side. You get the same from the ECB. The Bank of Japan is doing this since many years. So we have currencies which are backed by nothing. There is no value of anything which is outside of the government's hands today. We have only this debt money, and we have an inflation which is officially low, but as I explained earlier, it's not exactly the case. And so we're in this moment where in 2008, the only asset liquid enough where you could put your money in was, and to avoid and to get out of this monetary crazy system, was gold. The consequence of all this is that you need to understand that it's time to get out of the bank, because the value of money, and I also explained this a little earlier, the value of money is just rapidly going down. The US dollar purchase power was divided by 100 in the last 100 years. That's about what it is. It's going to zero. And like any fiat currency experience in the whole human history, it always ends at zero. And there is no exception to that. You know, that's the thing everybody has to realize. So where do you go if you just get out? If you have savings today, you know, the worst thing you can have is savings that are blocked in a bank. You know, we get in France, there are lots of life insurance policies, but this is the worst investment today, because your life insurance that you have is mainly invested in those government debt, and that's not good at all. So we all understand that this whole rig game, which is happening now since 2008, and that's going to be much worse now because of the coronavirus crisis, where we see now governments and central banks coming in at a rate which is even worse than what it is since 12 years, we all understand that it has a consequence which is very clear. It's to debase the value of your paper money at a very quick rate. So where do you go? Well, I would say if you want assets to remain liquid, of course, people are investing in art, you know, people are investing in real estate. But if you want something which is liquid, keep it at your fingertips, you know, not easily taxable. You know, there is gold, and now there is Bitcoin. And what is absolutely amazing, actually, is that exactly at that time, and when you look at the history, it's just unbelievable, you know. It's at that time, September 2008, when came out a white paper. You know, white paper is the name that is given to any new project especially in the technology sphere. So since now 20 years, as soon as you had a new project, you know, you come out with a white paper which explains the problem you're trying to resolve with your new project, and the solution you're bringing, which is your business model. So comes out usually it's a company, you know, it's a startup, but comes out a white paper, September 2008, called Bitcoin, a peer-to-peer exchange system by Satoshi Nakamoto. First of all, who is Satoshi Nakamoto? I'm not going to go deep into this because nobody knows, you know, that's also the beauty and the magical aspect of all this. This guy or this woman or this group or whatever is behind that name, you know, disappeared a few years after. Like I think the last email of Satoshi Nakamoto was received by some of the network of the geeks who were around him at the beginning. The last email of Nakamoto was received, I think, in 2012, 2013. So you're going to look into that. I'm not sure about the date. But then he vanished, disappeared. So this is September 2008. He came up with this, and really it was written black on white on this white paper that this project was the problem he pointed was the problem existing in the monetary existing system, and the Bitcoin system was a solution to humanity to solve this problem of exponential growth of money supply and allowing manipulation of all markets by government and by big players who were rigging the whole game and the whole markets with their ability to manipulate money. So with Bitcoin, this becomes impossible thanks to a new technology, which is blockchain. And that's the subject we're going to go deep into in session number 2. So that's it for today, for this session number 1. Thank you very much for watching. Don't forget you can subscribe directly on the blog, cryptoparadise.consulting. You just click on the button which is on the upper page. The blog is bilingual, French and English, and but you can also subscribe to my YouTube English channel directly. You'll have the link right on this video. Thank you. Bye-bye.